Good evening. Welcome back to Be Rich. Today I wanted to talk about a separate class of investment opportunities, what are known as credit default swaps. These credit default swaps are what created the bankruptcy of several insurance companies during the great crisis of 2008. The biggest company to go down under was American Insurance Group, AIG. Later, AIG had to be bailed by the US government and became AIA. In fact, AIG had a partnership with Tata's here, and these partnerships also got into trouble during this 2008. What is the credit default swap? Suppose you are a lender and you have lent money to a big company, or you have bought a group of tranche of securities which are basically mortgage backed securities in the market, or somewhere along the way you feel nervous that this loan may go bad and you may not get your money. So how do you protect yourself? You don't want to sell the security, but at the same time you want to buy protection. This is where insurance companies come in. They sell you what is known as credit default swaps. This is basically for a small premium free which the insurance accepts. He agrees to guarantee that in case event of a borrower defaulting, the insurance company will pay the loan. The product works just like your insurance premium. You keep on paying the premium, and once the default happens, if the default happens, the insurance company reimburses the money. Credit default swaps were not available for mortgage backed securities for a long time. During this crisis of 2008 is when the dangers of using credit default swaps became apparent to the world. Credit default swaps cannot be bought money by those who hold the loan. In fact, premium quotes are available for any investor to buy it in the open market. In fact, at that time, mortgage backed securities did not have a credit default swap. The idea was that real estate prices would continue to increase, and therefore these loans would not go bad. And even if these loans went bad, the underlying security could be sold at a higher price to recover the principal and the outstanding. But there were a set of investors who realized that this housing or mortgage boom could not last forever and there would be a correction. Michael Burry was one of them. He ran a hedge fund called Scion Capital. Scion Capital wanted to bet against the mortgage backed securities. So he went to a big bank and asked them that whether they would write a credit default swap for mortgage backed securities, even though he did not own them. The big investment bank thought that Michael Burry is an idiot and they could make easy money by just accepting the fees, and decided to create a credit default swap. Similarly, AIG also decided to create and sell credit default swaps for mortgage backed securities. The problem with mortgage backed securities was because the banks which were originating the loan did not keep the papers with them, they did not suffer the consequence of default. Therefore, the credit standards they employed kept declining because they wanted more and more securities which can be packaged into bands and sold. So, what they did is make it a lot of subprime loans. Subprime loans are loans given to borrowers who have high credit risks and therefore paid a premium on interest. So, these high yielding subprime loans were mixed with prime loans and then sold as a tranche with high credit ratings. Many pension funds and investors thought because of the credit ratings, there would be no risk of default and kept buying these stocks. As demand kept increasing, what happened is even banks started making no ninja loans. What were ninja loans? No income, no job advances. That is, people who had no income, neither had a job, were given loans. The idea was within 1 or 2 years, they would flip this house and make some profits. This was really bubble territory. But the belief was that the markets would never correct and real estate never falls. Unfortunately for them, real estate prices started to fall and foreclosures started to happen. But the news had not yet worked all its way into the market to the top in New York, and people continued to write credit default swaps. So, what happened was people kept on buying credit default swaps. These people were intelligent and knew the collapse would come. Even as the prices kept on increasing, they kept on buying credit default swaps. And the investment banks and insurance companies thought people like Michael Burry were idiots to buy it. When the inevitable happened and Bernstein's collapsed, then these credit default swaps went right through the roof because the holders had paid a very small premium amount, which was maximum 10 to 15% of the loan amount, and investment banks and insurance companies had to pay the full money back to people like Michael Burry, even though they did not own the bonds. The idea of the flaw was to allow people who did not have mortgage backed securities to buy default swaps. They had used this as a method to short the mortgage bond market. They did not directly short it, but the fact that they kept buying credit default swaps meant that they were shorting this market. Once this market got shorted, the prices went through the roof. When got shorted and the market started to going bad, the price of credit default swaps went through the roof, and American Insurance Group was in no position to repay all the loans it had insured, which had gone bad and had to go bankrupt, and they had to be bailed out by the treasury so that they could all honor all their commitments. There was a particular case in another large investment banker where one side of the firm was buying credit default swaps and the other side was selling it. There is a movie which is made out of this 2008 crisis called The Big Short, and there's a scene where the side which wrote the default swaps is asking the people who had bought those swaps to sell it to them, and he refuses. So this is what happens in a bull market when it becomes a bubble, when nobody knows exactly what everybody is doing and everybody is invested just because the market is going. I'm sure a time will come when credit default swaps are available across all countries, but a credit default swap is an important instrument for somebody who has taken a risk in mortgage based bonds or any bonds which is not government bonds. Thank you for watching. Be rich. If you like this video, kindly share it among your friends and relatives. If you are not subscribed to our channel, kindly subscribe to it. It's not enough to just subscribe to my channel. Turn on the bell notification. Only when the bell notification is on will you get the notification every time we put out a video.
I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support.